Hi, I'm Allan Madan, Chartered Professional Accountant. If you have family or investments in both Canada and the United States, you might be surprised by how differently each country taxes an estate when someone passes away. In this video, I'll walk you through a real-life example to explain how both countries handle estates, what happens to RRSPs, and how the stepped-up cost basis can help you avoid double taxation. Let's take a simple example. John Smith was a US citizen living in Toronto. When he passed away in 2025, he left everything to his daughter, Anna, who's also a Canadian resident. John owned three main assets: a Toronto home worth $1.5 million, an RRSP valued at $1 million, and 1,000 shares of Best Lucky phones, now worth $92 each. Let's see how Canada and the US each treat these assets. Canada doesn't have an inheritance tax. Instead, when someone dies, the Canada Revenue Agency treats all of their assets as if they were sold right before death, what we called a deemed disposition. That means any increase in value becomes taxable as capital gains or income on the deceased's final tax return. In John's case, his home qualifies for the principal residence exemption, so the gain on that is tax-free. His shares increased by $84,000, half of which is taxable, roughly $21,000 in tax. But the biggest tax bill comes from the RRSP, and that's where most Canadians are caught off guard. When an RRSP holder passes away, the full value of the plan is added to their income in the year of death. Unless the beneficiary is a spouse or a dependent child, there's no tax-free rollover. In John's case, the entire $1 million RRSP becomes taxable, creating a $500,000 tax bill at a 50% tax rate. Even though Anna, who is an adult, receives the full RRSP amount, it's the estate that owes the tax, and that can create cash flow problems if other assets need to be sold to cover it. Here's where things get complicated. Because John was a US citizen, the IRS views his RRSP as a foreign pension plan. Under the Canada-US tax treaty, the US doesn't tax the RRSP at death. The plan stays tax deferred until withdrawals are made. So while Canada taxes the full $1 million immediately, the US waits, creating a timing mismatch that makes it hard to claim foreign tax credits between the two countries. The good news is that both countries allow a stepped-up cost basis at death. This means that the cost base of inherited assets resets to their fair market value on the date of death. So when Anna inherits the house at $1.5 million, she's only paying tax on future gains. For example, if she sells it for $1.6 million, she's taxed only on that $100,000 increase, not on her father's lifetime gains. The US doesn't use a deemed sales system like Canada. Instead, it charges an estate tax on the total value of worldwide assets. For 2025, the exemption is $13.61 million per person, meaning most people like John with a $1.9 million estate don't pay US estate tax. And because unrealized gains aren't taxed at death in the US, there's no double taxation when combined with Canadian rules. Cross-border estate planning is full of opportunities to save tax. Here are a few tips. Plan for RRSP taxes early. Consider partial withdrawals or life insurance to fund the liability. Choose beneficiaries carefully. Sometimes naming the estate instead of individuals simplifies tax filing. Keep proof for the principal residence exemption. Monitor the US estate tax exemption, which is scheduled to drop after 2026. Always use consistent fair market values in both countries' filings to make treaty credits easier. At Madan Chartered Accountant, we help clients on both sides of the border file estate returns, claim treaty benefits, and plan ahead to minimize taxes. If you'd like help with cross-border estate planning, book a consultation today.